You made $5,000 from a client last year but never received a 1099. Do you still owe taxes on it? Yes. And in 2026, this is going to happen to a lot more freelancers. Here's why, and exactly what you need to do about it. Note: this information applies to US-based freelancers and self-employed individuals. Welcome to the Freelancers Wealth Blueprint. Let's make sure you don't get surprised by the IRS. First, the big change for 2026. Starting this year, the threshold for issuing Form 1099 NEC and 1099 MISC jumped from $600 to $2,000. This is part of the One Big Beautiful Bill Act signed in July 2025. What does this mean? If a client pays you $1,900 in 2026, they're not required to send you a 1099. At $600, they would have been required to. At $2,000, they're not. But here's what most freelancers get wrong. You still owe taxes on every dollar you earn, whether you receive a 1099 or not. The 1099 is a reporting document. It tells the IRS what you were paid. But your tax obligation exists regardless of whether that paperwork gets filed. Let me repeat that because it's important. Your legal obligation to report and pay taxes on income does not depend on receiving a 1099. Here's why this matters more in 2026. Before this change, if you did work for 5 different clients and each paid you $1,000, you'd likely receive 5 1099s. Now, with the $2,000 threshold, you might receive 0 1099s for that same $5,000 in income. You still earned $5,000. You still owe income tax and self-employment tax on that money. The only difference is the paperwork trail. And here's the trap. Some freelancers might think, no, 1099 means no record means no taxes owed. That's not how it works, and the IRS has ways to find unreported income. Payment apps like PayPal, Venmo, and Stripe still report through Form 1099-K if you receive over $20,000 and have more than 200 transactions. Bank deposits can be traced, and if you're audited, the burden of proof is on you. So what exactly do you owe? As a freelancer, you owe 2 types of tax on your self-employment income. First, income tax based on your tax bracket. This varies depending on your total income. Second, self-employment tax at 15.3%. This covers Social Security at 12.4% and Medicare at 2.9%. In 2026, the Social Security portion applies to your first $184,500 in net self-employment earnings. The minimum threshold for owing self-employment tax is $400 in net earnings. If you made $400 or more from self-employment, you need to file Schedule SE with your tax return. Let me give a real example. Sarah is a freelance writer. In 2026, she has 6 clients. Here's what they paid her. Client 1, $1,500. Client 2, $2,800. Client 3, $2,500. Client 4, $800. Client 5, $200. Client 6, $3,000. Total income, $10,800. How many 1099s did Sarah receive? Just 2. Only the clients who paid $2,000 or more are required to send one. Sarah only has documentation for $5,500 of her income. The other $5,000, no 1099s. But Sarah owes taxes on all $10,800. If she only reports the $5,500 that's documented, she's underreporting nearly half her income. The IRS penalty for underreporting can be 20% of the underpaid tax, plus interest. If Sarah owes roughly $1,500 in taxes on that unreported $5,300, the penalties could add another $300 or more. Not worth the risk. Here's how to protect yourself. Step 1. Track every payment yourself. Don't rely on 1099s. Keep a spreadsheet or use accounting software to record every client payment, the date, the amount, and the service provided. This is your primary record, not the 1099. Step 2. Save your invoices. Every invoice you send is proof of work performed and expected payment. Keep digital copies organized by client and year. Step 3. Document bank deposits. Your bank statements show every deposit. If you're audited, you'll need to explain each one. Make it easy on yourself by keeping notes as you go. Step 4. Use a dedicated business account. Mixing personal and business transactions makes tracking nearly impossible. A separate account creates a clear paper trail and makes tax time much easier. Step 5. File Schedule C accurately. Report all your business income on Schedule C, not just what's on your 1099s. List your total gross receipts, then subtract your legitimate business expenses to get your net profit. Step 6. Pay quarterly estimated taxes. The IRS expects you to pay taxes as you earn throughout the year. Due dates are April 15th, June 15th, September 15th, and January 15th. Missing these can result in underpayment penalties. Now, what about 1099-K? This is the form payment processors send. In 2026, the threshold for 1099-K is $20,000 in payments and more than 200 transactions. This applies to payment apps and online marketplaces. Important note: payment card transactions have no minimum threshold. If you accept credit cards through a processor, they'll report everything. So even without 1099 NECs from your clients, you might still get 1099-Ks from PayPal, Stripe, or Square that show your income. But here's the catch. 1099-K shows gross payments, not net income. It doesn't account for returns, refunds, or fees. You'll need to reconcile this with your actual business income and may need to report adjustments on your return. Here's the bottom line. The new $2,000 threshold for 1099 NEC and 1099 MISC means fewer freelancers will receive these forms. But fewer forms doesn't mean fewer taxes owed. Track your income yourself. Keep good records. Report everything. Pay quarterly. The IRS expects to be paid whether or not you receive a 1099. Don't let a missing form turn into an audit or penalties. If you want to learn how much you should be setting aside for taxes, check out our video on how much freelancers actually owe on $65,000 in income. Link in the description. See you in the next one.